Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Okay, we'll start off today by talking about your mid-semester exam. Thanks, mate. Okay, so let's talk about your mid-semester exam. So in terms of results, the average mark for the mid-semester exam was 16 out of 25. Okay, so that's a mid-credit, which was kind of what I expected. So that's pretty good. All the results went up on Friday, if you're wondering. So if you go to the My Grades tab, you can see your result. And the copy of the exam with solutions is also up. In terms of reviewing your exam, the only place you can do that is in the tutorial you are enrolled in. Okay, so you must attend the tutorial you're enrolled in this week. For the first 10 minutes, you'll get to have a look at your exam. Your tutor may put up the solutions, but you might want to bring along solutions just in case as well. Okay, so we'll go through the exam itself. Hopefully nothing in the exam should have been too surprising for you. You would have seen it all before. You may not have liked some of the questions, okay, but it's pretty much what we've been covering in the tutorials and lectures itself. So let's make this a little bit bigger. Okay, so the first question was valuing a forward contract. Okay, so you've got some information about a company, Energy Limited, and what they're doing is they're paying dividends in 3 and 6 months' time. You're given the current share price, you're given the risk-free rate, it's compounded quarterly, so you have to convert that to a continuously compounded rate, and you're taking a short position in a 9-month forward contract, given the information, answer A and B. Okay, so this is similar to a quiz you had, right? Very similar to a quiz you had, except we're including dividends, and you had to convert the interest rate. Okay, so what are the forward price and initial value of the forward contract? So the first thing you would need to have done is calculate the continuously compounded rate. So because it's compounded 4 times a year, it's going to be 4 times the natural log of 1 plus the interest rate given in the question divided by 4. And that gives you 0.035433394. Again, keep all the decimal points. And then you have to find the present value of the 2 dividends. So the first one's paid at month 3. So you have to bring that $2.25 back to time 0. So you just multiply it by e to the power of your negative interest rate times 3 on 12, because you're bringing it back 3 months. And dividend 6, you have to bring that back 6 months. So you just multiply it by e to the power of negative your interest rate times 6 on 12. And then in your formula, it's simply the current share price of $42.62 minus those 2 dividends that you discounted back, and then the life of the contract is 9 months. So e to the power of the risk-free rate, sorry, your continuously compounded rate multiplied by 9 on 12, and then to give you $39.20. And the initial value always is 0 of any forward contract. Later on, though, the price has changed, right? So you're now 5 months into the contract. So if we go back up to the question, sorry. So 5 months later, so in that 6-month time period, 9-month time period, you're now 5 months into it. The share price has now dropped to $28. Risk-free is the same. what are the forward price and value of the short position in the forward contract. So, first of all, the interest rate's the same, so you don't have to do anything with it. It's still compounded quarterly. That dividend of $2.25 is paid at month 6. Well, you're now 5 months into the contract, so you have to discount it back 1 month to time period 5 months. Okay, so you multiply it by e to the power of negative your interest rate times 1 on 12 to bring it back 1 month. We ignore dividend 3 because it's already been paid. Okay, it doesn't form part of the calculation. And then that gives you a new forward price of $28, the current spot price, minus the present value of that single dividend. Because you're 5 months into a 9-month contract, there's still 4 months to go. So you raise it to e to the power of your risk-free rate times 4 on 12 to give you $26.06. So now the value of the contract is going to be the original $39.20 minus the new $26.06. And again, you discount it back 4 months because you're at time period 5. The contract has a life of 9 months. So you bring it back 4 months to give you a value to you of $12.99. Okay, so in terms of difficulty of this question, I would rate this as an average question. Right, I'd expect most people to get this question correct. Okay, it was similar to a quiz question you had, and the only slight change was you had to include dividends. Okay, but this is average question. I'd expect most people to be getting this correct, and most people did get it correct. Question 2 was a swap question, okay, and it was an investment. Okay, so in this question you want to try and get the highest possible interest rates you can get. Okay, so you want to increase the interest rates. So as we know, first of all, you've got to work out the differences, the absolute differences, work out the differences between the absolute differences, and that's what you've got to play around with in the particular swap contract. Okay, so if we have a look at the solutions. Okay, on the fixed, the difference between 3.5 and 5.2 is 1.7%. The difference on the variable, LIBOR plus 2, LIBOR plus 2.3, is 0.3%. And that gives us an absolute difference of 1.4%. So you've got 1.4% to play around with, but you're told the intermediary takes a cut of 20 basis points, so 0.2%. So 1.4 minus 0.2%, you've got 1.2% left to play around with in terms of making both parties better off. Now, you're also told that they don't share the gains evenly. Okay, you're told that LL has 80% of the remaining gains, so there's 1.2% remaining, so they take 80%, so they have to get 0.96%, and JJ takes 20% of the gains, so they get 0.24%. So company L, we know, wants LIBOR. Well, at the moment they can get LIBOR plus 2.3%, so we have to give them an extra 0.96%. So in the end, we want them to end up with this, LIBOR plus 3.26%. JJ wants fixed. At the moment, they can only get 3.5%. We're going to make them 0.24% better off, so they end up with 3.74%. The question also told you, when you draw the swap, to pay the variable rate all the way across, the LIBOR rate all the way across, which is what we discussed in lectures multiple times. So in terms of the swap, remember they borrow at what they don't want. So JJ is going to borrow at the variable, LIBOR plus 2%, and then you've got an arrow coming in because they're receiving the interest payments because they're investing. And then for LL, they're going to borrow at the fixed. So they've got 5.2% coming into them, even though they want the variable rate. And then we pay the variable rate all the way across. So the LIBOR plus 2% that goes into JJ, that gets paid all the way across. So JJ pays it to the intermediary, LIBOR plus 2%. The intermediary pays it to LL, LIBOR plus 2%. Now it makes it really easy for you to solve because we know that we want to end up with JJ having 3.74%. At the moment they're receiving and paying out the same amounts, they cancel out. So let's make the intermediary pay JJ 3.74%. Okay, so now they're sorted out. We know that JFK takes a 0.2% cut, so let's just subtract it here. So they pay out 3.74, let's make them receive 3.94. The difference there is the 0.2%. Here they cancel out, receive LIBOR plus 2%, pay out LIBOR plus 2%. And now if you do everything, LL, they all get the amounts as required. Okay, and you had to show this, right, that they all got their amounts as required. Okay, again, most people did pretty well on this question. This, again, to me was an average difficulty question, right? It's nothing that we hadn't done examples for in the lecture. I spoke about, taking different cuts, things like that, dealing with investments, dealing with loans. Okay, so it wasn't too bad, too hard a question in my view, and it was done reasonably well. Not as well as I would have liked, but done reasonably well. The markers were a bit lenient, right, in terms of people doing different things with the swaps as well. Okay. And then in terms of question 3, so there was a bit to it. The first one, again, pretty much straight from an example we've done in class and in tutorials. So this is an optimal hedge ratio. So remember, the optimal hedge ratio is equal to the correlation multiplied by the standard deviation of the spot price divided by the standard deviation of the futures price. So in this question, you're hedging with something that's not the same as your spot asset. Okay, so you're hedging soybeans with wheat futures contracts, so they're not the same. Okay, but you're given all the information. The correlation is 0.84, standard deviation of the spot 1.7, standard deviation of the futures 1.3, to give you 1.09846153 is our optimal hedge ratio. Now you're told you've got 400,000, so you have to divide by 50 because each contract's for 50, and then you multiply it by that optimal hedge ratio of 1.098, blah, blah, blah. So you end up with, take a short position, right, because they're wanting to sell, and we round it up to 8,788 wheat futures contracts. Okay, you can't buy 0.69 of a wheat futures contract, you can only buy a whole number. Then the next question was, why is a convertible bond considered an option? Okay, and 2 main reasons. You've got the right to convert it into shares, and therefore it's callable like an option. Okay, because the holder, right, can convert these into shares at any point in time. And then question C, using 2 portfolios, derive the lower bound for the price of a European call option on a non-dividend paying stock. You must draw a table illustrating the initial and terminal values. So this is just straight from the lecture notes on how we derived the lower bound for a call option. So portfolio A has 1 call option and cash equal to the present value of the exercise price, and portfolio B has 1 unit of the underlying asset whose value is just S0. And then over here we talk about whether we exercise the options or not. So here the call option gets exercised, the payoff is ST minus X. Here it doesn't, so the payoff is 0. The cash grows to equal X in both scenarios. So here portfolio A is worth ST minus X plus X, so ST, and over here it's worth 0 plus X, so X. And in both situations, portfolio B is just worth ST, the final spot price. So A is always greater than or equal to B. Okay, it's always worth the greater amount. And what is A? C plus XC negative RT. What is B? S0. Rearrange, and we remember that C cannot be less than 0, so it's the maximum of S0 minus XC negative RT and 0. Again, in my head, this was not a difficult question, but it was probably done the worst, okay, in the whole exam. People just didn't know, some people didn't know how to draw the tables, okay, what to do here, and some people forgot that the maximum bit here, down here as well. Okay, it has to be the maximum, it can't have a negative value as well. And finally, question D. Suppose that ordinary shares in JRB Limited are currently selling at $55. A 23-week European call option has an exercise price of 50. Risk-free rate is 6.5% per annum compounded daily. What is the upper and lower bound for the price of this European call option? Okay, so again, straight from the lecture notes. Okay, so remember, it's compounded daily, so we've got to convert it to a continuously compounded rate that's compounded daily. So 365 times the natural log of 1 plus the rate divided by 365 gives us 0.06499421. Yes, keep all the decimal points. Don't just say, oh, it's about 6.5%. It's not. It's 0.64994212. Now, the upper bound of any call option is just the current spot price, which is $55. So that was easy. And the lower bound, well, you just substitute into the formula you just solved for anyway. So 55 minus 50 times e to the power of continuously compounded rate. It's got a life of 23 weeks to give you a lower bound of $6.42. Okay, and that was your exam. Okay, that was your mid-semester exam. Okay, so the highest mark, I said the average mark was about 16. The highest mark was 25, obviously. There were quite a few of those. And the lowest mark was 0 because someone didn't write anything. So you can't get marks if you don't write anything. Okay, but on the whole, my head, you can tell me now, I thought it was probably an average to easy exam. Okay, so I would have expected a bit higher than 16. Okay, but I guess it's not too bad. What are your thoughts or anything you'd like to share on the exam? Anyone like to share anything? Now is your chance. I'll share something. Your final exam, I would expect to be harder than this. Right? There's more content that we can cover, right? And harder parts of the course itself. Okay, so I would expect your final exam to have a couple of questions like this, one question a bit harder, and one question a lot harder, okay, than this in your final exam. That would be my expectation as the person setting your exam. Okay. Anyone like to give some feedback about the exam? Was anyone surprised in the exam? Hopefully I've pointed out today that you'd covered all of this, right? It's always a matter of how much you prepare, obviously, for exams. Does everyone have enough time to do the exam? Okay, so in my head, different to your head, I thought about an hour to do this exam, so gave you extra time to check your answers, things like that. Okay, a lot of people left early, that's fine. Okay, but that's where you pick up some careless mistakes sometimes, so check your work if you can. Any feedback anyone would like to provide? No feedback. Who sat the exam? Raise your hand if you sat the exam. Most of you did, right? I think 589 out of 612 did, so most of you sat the exam. Okay, so if you'd like to give me feedback later, please feel free to come and chat to me and give me some feedback. Okay, so today we're going to move on to I guess a continuation of what we've been doing in the last couple of weeks. So we've dealt with lower bounds, we've dealt with the binomial option pricing, we've dealt with the Black-Scholes model, and we've done that in a world with essentially no dividends, or we introduced dollar dividends in the last lecture. Okay, in this lecture today, we're going to look at options on assets that do provide an income. Okay, so things like currencies and things like indices. So we know that indices pay dividend yields, and we also know that currencies, if you own a foreign currency, the rate of return is the foreign risk-free rate of interest. Okay, that is your rate of return. Okay, so we did that in the first couple of weeks. We spoke about it. So the question is, how do we adjust, how do we change everything you've done in the last couple of weeks to take into account these different assets? And it's actually pretty easy. Okay, all you really do for most of them is wherever you see an S0, you replace it with an S0 times e to the power of negative QT, where Q is the dividend yield, or e to the power of negative RF, where RF is the foreign risk-free rate of interest. Okay, that's the main change you do for these. Okay, so it's pretty straightforward. Okay, but why do we do that? Why do we say S0 times e to negative QT? And that's what the next couple of slides talk about. The reason for that is, let's imagine two identical assets that give you exactly the same amount of return. One pays dividends, one doesn't pay dividends. Okay, so imagine the one that doesn't pay dividends. Its stock price goes from S0 to ST. Yep, and all you get is the capital growth in the share price increasing. Then you've got another one that again provides the same return, but this time its price also goes from S0 to ST, but there's a dividend, right, of Q%. And the question is, how do we capture that dividend that you're going to receive by owning the share? And the way we do it is we say, well, imagine the dividend hadn't been paid. Imagine the company hadn't been paid the dividend. Well, then the share price should have increased by the amount of the dividend as well, right? Because we know when dividends get paid, share price drops by the amount of the dividend. So if that company that does pay a dividend, if it didn't, its stock price would have grown from from S0 to ST times e to the power of QT. Okay, an extra amount of dividend. But that's tricky for us to do because we do deal in present debt values. So the way we think about it is instead say, well, let's imagine its final price is still ST, but rather than the beginning price being S0, it's now S0 times e to the power of negative QT. So essentially what we're doing is we're removing the dividend yield from the beginning price, and it ends up being whatever its final price is. But we incorporate the fact that you are entitled and you would get a return of that dividend yield from owning that particular asset itself. Okay, and that's what these couple of slides talk about. Okay, so as I said, we're going to talk about options on stock indices and currencies. So in Australia, the main stock index, who remembers what it is in Australia? ASX 200, right? So people argue whether it's the ASX 200, ASX 300, or the All Ordinaries, which is the top 500 companies. Okay, but if you look at what investors automatically refer to, it's the top 200 companies. Okay, the ASX 200. So you can trade options on the ASX 200, on the ASX itself, right? So you can buy and sell options on the ASX 200. And the ASX 200 gives you a dividend yield. At the moment, it's about 5%. Okay, so Q, if you like, would be about 5%. So how does stock index options and individual stock options, how do they differ? Well, we know from what we've done in Foundations of Finance and in this course, is that when you buy an option on a stock, say BHP, it's automatically got a dollar value. Okay, it's going to be related to what its current stock price is, right? And then you plug it into the binomial, the Black-Scholes model, right, to try and get what that option price would be. For an option on an index, though, you get it in points, right? So you get the current level of the ASX is 6,200 points. Right, well, that doesn't really help you in terms of finding the value for an option. So remember, the convention we use is that we multiply all those points by $25 to give us a dollar value. Okay, so if this is in your final exam, I wouldn't tell you that, right? I'd expect you to remember that. Okay, but if I say to use another amount, we're doing an American one, and I say it's $100 per point, I would tell you that, then you'd use it. But if I don't tell you in the final exam, you have to multiply it by $25 per point. Okay, index options are cash settlement, right? Because you can't actually physically deliver all the 200 shares, right? That's not the way index options work. Okay, so it's just going to be the difference between the spot price and the exercise price of the ASX 200 in terms of the cash difference, in terms of what you receive. Okay, and normally, okay, they're European in nature. So what formula would we use? Silence. What formula? Black-Scholes, right? Black-Scholes is for European, binomial is for American. Okay, remember, I'm likely in a final exam to give you all the information to solve using both binomial and both Black-Scholes and expect you to know based on whether it's American or European. Okay, I like to do that one. Okay, options on foreign currencies. So as I said, when you hold a foreign currency, your rate of return is the foreign risk-free rate. Okay, in this course, we denote the domestic risk-free as R and the foreign as RF. Okay, so don't confuse RF with just risk-free. RF is your foreign risk-free rate of interest. The return is the foreign risk-free rate, and normally they are over the counter, right? Increasingly, though, we do see these being traded on exchanges as well. Okay, as foreign trade and trade amongst countries increases, we have an increased use of these being traded on the exchange. Okay, and the biggest one in the world is the Philadelphia Stock Exchange. Okay, and they can be either European or American. Okay, so in terms of what happens when payments get made, so the payments, remember, are dividends in terms of an index, and the foreign risk rate of interest with currency options. What happens when dividends get paid? Prices fall. So the spot price falls. Is that good or bad for a call option? So automatically what you should be doing is sitting there going, what does he mean, first of all? Then the second thing is, what is the payoff from a call option? Okay, and it's S minus X. Right, so if I tell you you've now got an asset, unlike previous weeks where it didn't pay dividends, is the payment of dividends or income good or bad for the payoff of a call option? Bad, thank you. It's bad because the spot price is lower, so the payoff is going to be lower. Right, so that's bad, but what I mean by bad is it means it's going to be a cheaper option, a cheaper call option. And the reverse is true for a put option. Remember, a payoff from a put option is X minus S, so as S drops, you get a bigger payoff from a put option. Okay, so you're going to see the price of put options increase. Okay, so really simple theory question for a final exam, right? I say to you, think about call and put options. What does the payment of dividends do to the value of those options? Call option lowers the value, put option, it increases the value. But what we need to talk about is the bounds. And we're going to do it, again, by proving the lower bounds using our table format. If I can get the light to work. There we go. Okay, so for our lower bounds, first of all, let's deal with our call option. Okay, so we are going to have identical for portfolios as we had in lecture 4, except we replace S0 with S0 times e to the power of negative QT. Okay, so again, we just remove the dividend yield. So portfolio A is going to be comprised of one call option and cash equal to the present value of the exercise price. And portfolio B is going to be comprised of S0 times e to the power of negative QT shares. Okay, so again, all we're doing is removing the dividends from the current share price. Okay, imagining that we can go ahead and do that. And then we set up our table. Okay, so again, this should hopefully be becoming familiar that we've done this for a couple of weeks now. So we have our portfolio A and our portfolio B. We have, time 0, and we have what happens at maturity. So at time 0, we have a call option, and we have cash equal to the present value of the exercise price. So that gives us C plus XE negative RT, and portfolio B is S0 times e to the power of negative QT. So portfolio B is just worth S0 times e to the power of negative QT. And then we're worried about whether these options get exercised or not. Okay, so where does the call option get exercised? Where it's less than or greater than? Greater than. And what's my payoff? Yes, ST minus X. What's my payoff over here? What's my value here? Value here. So I add it up, I get ST, the X's cancel out, add it up, and I get X. What does the share end up being worth at the end? ST. So this is exactly the same as what you did in your mid-semester exam. Exactly the same as what we did in lecture 4. What differs is you've got this S0 times e to the negative QT. There's an assumption we're making here. Does anyone know what assumption we're making in terms of the dividends to get a value of ST here? What are we assuming about those dividends? Yes? They're certain. Yes, they're certain. What else? What are we doing with those dividends? Okay, essentially we're reinvesting them. Okay, we're reinvesting them in the share price. Okay, by reinvesting them, we're buying more shares. Okay, so no matter what happens, it's worth ST. So when ST is greater than or equal to X, both portfolios are worth ST, so they're equal to each other. And when ST is worth less than X, portfolio A is worth the greater amount of X. Okay, so A is greater than B. So that gives us A is always greater than or equal to B. What is A? C plus XC negative RT, straight from here. What is B? S0 times e to the power of negative QT. Rearrange. And then we know that that the core price can't be negative in value, so it's the maximum of S0 times e to the power of negative QT minus XE negative RT and 0. Okay, so that's proving your lower bound. And if for a indice, and if it was a currency, you would just have RF here. Okay, the risk-free rate, the foreign risk-free rate. Okay, that's call options. Any questions on call options? Okay, put options. So lower bound of put options. So portfolio C has a put option in it, and it also has 1 unit of the underlying asset, but we remove the dividend yield. And portfolio D is equal to cash. Okay, the present value of the exercise price in cash. So again, we draw our table. We have portfolio C, portfolio D, a put option, S0 times E to the negative QT, and cash equal to the present value of the exercise price. So this is P plus S0 times E to the negative QT, and this is my cash. And then times 0, and at maturity. So ST is greater than or equal to X, or ST is worth less than X. So where does the put option get exercised? Where it's greater than or less than? Less than. So over here, and what's my payoff? Thank you, X minus ST. What's the payoff here? What's the value here? Value here. 0 plus ST is ST. X minus ST plus ST. ST's cancel out, give us X. What's my value here? So it's always worth X. So when ST is greater than or equal to X, C is worth more than D, right? Because ST is worth more than X. So C is greater than D, and when ST is worth less than X, portfolio C is worth X, as is portfolio D. So they're equal to each other. So C is greater than or equal to D in all situations. And then again, we just plug in and replace what is portfolio C and what is portfolio D. So portfolio C is P plus S0 times e to the power of negative QT is greater than or equal to XE negative RT. Rearrange, P is greater than or equal to XE negative RT minus S0 times e to the power of negative QT. And again, the put value can't be negative, so it's the maximum of XE negative RT minus S0 e to the negative QT and 0. Any questions there? Okay. So let's have a look at put call parity next. And again, we have our two portfolios, E and F. E is call option, present value of the exercise price. F is my put option, and 1 unit of the underlying asset, but with the dividend yield removed again. And I draw my table. Portfolio E, portfolio F, time 0, time T. Excuse me, P plus S0 e to the power of negative QT. Okay, where is the call option exercised? Greater than or less than? Should be yelling this out. Greater than or less than? Greater than. What's my payoff? What's my payoff here? What's my value here? Value here? Perfect. Value here? Value here? Excellent. What's my payoff here? Excellent. What's my payoff here? Excellent. What's my value here? Value here? And what's my value here? Value here? Excellent. I don't even need to be here. Fantastic. Okay. So when ST is greater than or equal to X, both portfolios are worth ST, so E is equal to F. And when ST is worth less than X, both portfolios are worth the same amount, X dollars. So no matter what happens, portfolio E is equal to portfolio F. So C plus XE negative RT is equal to P plus S0 times E to the power of negative QT. Okay, and that is your core parity proven. If this was a foreign currency again, instead of it being negative QT, it would be negative RFT. Okay, but it's a slight change from what you've learned. Okay, again, the only formula you get in your final exam, remember, is that basic Black-Scholes formula. The changes we do today when we look at Black-Scholes, you'll have to remember how the formula changes. Okay, but it's pretty straightforward. Any questions on the lower bounds or core parity at all? Anyone's not sure about? What we're going to start doing in next week's lecture is we're going to start talking about the violations and the arbitrage strategies we're going to start making. Okay, because chances are I'm not going to ask you to do this in the final exam. Instead, I'm going to show you violations and get you to show me how you'll make money out of it. Okay, arbitrage profits, okay, out of it. So we'll do that next week. Okay, so in terms of the binomial option pricing model and the changes we have to do there, they're actually pretty straightforward. So these are just what we've covered. Okay, we'll give it a second, it's frozen. So in terms of the binomial option pricing model, the good news is nothing much changes. How you calculate U and D doesn't change. Okay, it remains the same. How you draw the tree doesn't change. How you calculate your payoffs doesn't change. Only one thing changes, and that's how you calculate P. Okay, remember P is your probability of moving up the tree, and 1 minus P is your probability of moving down the tree. Okay, so that's the only thing that changes. Everything else remains the same. So in terms of calculating P, remember it was, who remembers what it was? P is equal to what? E to the power of RT minus D divided by U minus D. And what was T? What did T have to be? Fantastic. The length of one time step. Perfect. Okay, so if you've got a 2-step 6-month option, that T would be 3 on 12. Okay, not the length of the whole tree. The only change you make is, rather than being e to the power of r times t, it's now e to the power of r minus q times t. That's it. So you just subtract the dividend yield from the current domestic, if you like, risk-free rate. If it's a currency, it would be e to the power of r, the domestic rate, minus rf, the foreign rate, times t. That's the only change you have to make, okay, in terms of calculating the value of an option using the binomial model. So next week you have a quiz, right? And your quiz next week will be on the binomial option pricing model with indices or currencies. Okay, so pay attention to what we're about to do. Okay, so that's your quiz next week. Okay, but again, straightforward. One simple change we make. Okay, and that's how we calculate P. Okay, so P goes from being ERT to e to the power of r minus q times t, minus d divided by u minus d. That is the only change you make. Everything else remains exactly the same. Again, it's just the present value of your payoffs, taking into account the probability of getting those payoffs. And that is, back to foundations of finance, the price of any financial asset. Present value of future payoffs, taking into account the probability of getting those payoffs. So we have this question here. We have a 6-month put option. Okay, so a 6-month put option on a stock with a strike price of $40, so X equals 40. Suppose that the initial stock price is 50, and the stock price can either move up to 60 or down to 35 during a 6-month period. Risk-free rate 6%, and dividend yield is 2%. Again, because it doesn't tell us how frequently they're compounded, we'll assume they're continuously compounded. Okay, unless it tells me otherwise. Okay, so let's go about solving this. Okay, so this is our binomial model. So the only thing that changes is we now calculate P as P is equal to e to the power of R minus Q times T minus D divided by U minus D, or P is equal to e to the power of R minus the foreign risk-free times T minus D divided by U minus D. So for this particular question, if we draw our tree diagram, we started at a price of 50, and we could go up to 60, or we could go down to 35. It was a put option, and the exercise price was $40. So because it's a put option, you've got the right to sell for $40, but you're not obligated to do so. So what's the payoff up here? Zero. Why is it zero? Why would you sell for 40 when you can sell for the spot price of 60? What's the payoff down here? $5. Excellent. Just my exercise price of 40 minus 35 to give me $5. Okay, so now I have to solve for P. What is U and what is D? How do I calculate U in this particular question? Remember, there are 3 ways to calculate it. Either I give you the percentages, I give you annual volatility, or I give you final prices. If it's final prices, U is going to be equal to what divided by what? Thank you, 60 divided by, so the final price, if I go up, divided by the beginning price, which gives me 1.2. So in other words, prices have gone up 20%. Or D, which will be 35 divided by 50. The price, if I go down, of 35 divided by the beginning price of 50 to give me 0.7. Other information, the risk-free is 6%, dividend yield is 2%, and T equals a half. Okay, half a year. So I solve for P first of all. So P is equal to e to the power of R minus Q times T minus D divided by U minus D, which gives me e to the power of 6% risk-free minus 2% dividend yield. Now it's only a 1-step tree, so it's 6 months, minus D of 0.7 divided by 1 minus 2 minus 0.7 to give me 0.6404. So remember, when you calculate P, just round to 4 decimal points. Okay, you don't need to keep all the decimal points after that. And 1 minus P is therefore 0.3596. Okay, just 1 minus 0.6404. And again, when calculating the value, exactly the same as what we did in lecture 5 with the binomial. It's going to be the present value, so e to the power of negative risk-free of 6% times half a year. I've only got one payoff. That payoff was $5. To get that $5 payoff, remember, I went down the tree. Okay, and the probability of moving down the tree is 1 minus P. So I multiply the $5 by 0.3596, and that gives me a value of 1.74. Am I finished? Am I finished? No, I'm not finished. Why am I not finished? Because I need to say, would I exercise early at this node here? Okay, would I exercise early at this node here? Yes or no? No, right? You wouldn't exercise early because exercising early would give you a negative value, right? Exercise price is 40. 40 minus 50 would give you negative 10. So you need to make the statement, do not exercise early as would lead to a lower payoff. Okay, remember your decision rule, right, is always take the higher value, right? So if exercising early leads to a value greater than the value you've discounted back, replace it. Okay, just like we did in lecture 5. Okay, so I would imagine your quiz next week would not be a one-step tree. I'd imagine it would be a two-step tree. I wouldn't do a three-step tree in 10 minutes. That might be a bit nasty. Right? I imagine it would be a two-step tree. Okay, but it's going to be American, obviously, so you need to consider early exercise. Would you exercise early at the particular nodes? Okay, and make sure you label them correctly. Okay, are there any questions on the binomial option pricing model? Again, the only change we make is replacing R with R minus Q in terms of calculating P, or R minus RF if we've got a foreign currency. Okay, so let's take a break before we look at the Black-Scholes model, and we'll come back in 7 minutes. Thank you. If any questions, please come down and see me. Anything about your mid-semester exam. None of you should have seen your exam yet, but if you do have questions about it, please feel free to come down and ask. is one that I wouldn't say is straightforward, right? This is a little bit more difficult. Okay, so the ASX is currently trading at 5,450 points, pays a dividend yield of 4.5% per annum continuously compounded. That's fine. Risk-free rate is 2.25% per annum compounded weekly, so it's got to be converted to continuously compounded. The volatility index is 35% per annum, continuously compounded. Using the binomial option pricing model, calculate the value of a one-year American call option on the index with a strike price of 5,300 points. In providing your answer, you can assume there are 3 time steps of 4 months each, and you must include a diagram of the binomial tree with all nodes clearly labelled. Okay, so what's a little bit more difficult in this question is that you have 3 steps, okay, in terms of the tree. Okay, not the 2 steps, which is the most we've covered so far in our lectures. So if we go down to have a look at it, okay, so a couple of things you need to do. Like I said, you need to convert that interest rate. Okay, so at the moment it's compounded weekly. So to convert it, we say 52 times the natural log of 1 plus the 2.25% divided by 52. Gives me 0.022495133. Okay, keep all your decimal points. And then you need to calculate U and D. Remember, there are 3 ways to calculate U and D. Either you're given percentage changes, you're given dollar values, or in this case, you're given annual volatility. Okay, so for my annual volatility, U is going to be equal to e to the power of that annual volatility. It's got to be continuously compounded, remember, in this question is, so we can use it as given, multiplied by the square root of t, where t is the length of each time step. So in this case, 4 on 12, or a third. So that's going to give me e to the power of 0.35 times the square root of a third, 1.223936856. Keep all the decimal points. D is equal to 1 minus u, sorry, 1 divided by u, so 0.817035613. And now you've got to draw the tree. Okay, you haven't been given any of the values in the question, you've just been given the starting value. So now you have to use u and d to actually draw out your tree and work out what are the values at each particular node. Okay, so we'll do the tree first and then we'll come back to the value of p. So the 5450, to go up the tree, you have to multiply it by u, okay, which is your 1.223968856. Okay, so you multiply it by that to get this number here. Then you multiply it by your d to get the number down here. Here again, you multiply by u again, and then you multiply by u again to get the final values. And all the way across, right, until you get all of these. And you'll see I've labeled the nodes A, B, C, D, E, F, G, H, I, J. Okay, so there's a lot of nodes. Okay, in terms of calculating P, here's the difference we have today. Because it is an index, it's a currency, it's a index which pays a dividend yield, we have to say e to the power of r minus q, okay, my dividend yield, which was 4.5%, times t minus d divided by u minus d. Okay, and that gives me 0.4313, so we've got a 43% chance of moving up the tree. And then 1 minus p, I've got a 56% chance of moving down this particular tree. Okay, we take that into account when we actually value our payoffs later on. So we had to go through, excuse me, and draw our tree. Okay, and remember it was a call option, and the exercise price was 5,300. So at node G, we say 9962.486 minus 5,300 gives me a payoff of 4692.486. Again down here, 6670.456 minus 5,300 gives me 1370.456. And then down here, I don't exercise the option, okay, because the exercise price is 5,300. I'd rather pay the cheaper price of 4452 and 2972 than 5,300. So we have 0 payoffs down here. So now I have to find the values at the nodes. So in this time tree here, there's no value to find here, right? Because 0 and 0 goes back, and the exercise price is 5,300, so you wouldn't exercise it here. But we are going to worry about D and E. So at D, what happens? Well, at D, we say e to the power of, and here's my continuously compounded discount rate I calculated. The length of the time step is a third, and then I've got a payoff of, where is it, 4692. To get from D to E, you had to move up the tree. So I multiply that 4692 times P, the probability of moving up the tree, plus the 1370. To get from D to H, you had to move down the tree, so multiply it by 1 minus P, the probability of moving down the tree. What does that give me? That gives me 2782306,341. But it's American, right? So I've got to look at early exercise. So for early exercise, it's going to be 8164.217 minus 5,300, which gives me 2864217. Early exercise gives me a greater number, so I say I do exercise early, and now I discount back 2864.217. Okay, exercising early leads to a greater value. At node E, the only value I can get is this 1370, so I have to discount that back to node E. To get from E to H, you had to move up the tree. So I find the present value of the 1370 multiplied by P. Again, to get from E to H, you moved up the tree. That gives me 586.662. As the exercise price is 5,300, exercising early would give you 150. 586 is higher than 150, so you do not exercise early. Okay, you need to have these statements, either exercise early or do not exercise early. And the reason, lower payoff. Reason here, higher payoff. Now I need to go from D to B, E to B, and E to C, right? Because there is a payoff here as well. Okay, so it's a long time. So the value at node B, first of all, present value, and it's going to be the 2864, that was the greater number, remember, from early exercise, multiplied by P, because to get from B to D, you moved up the tree, so it's multiplied by P. And then we have that 5866.662, and that's multiplied by 1 minus P, because to get from B to E, you move down the tree to get that particular payoff. Okay, that gives me 1557.250. Now, exercising early here would leave me with a payoff of 1370. 1557 is greater, so I do not exercise early. And then, you've got a lot of steps. Node C, well, there was a payoff here, remember. So I have to go from E down to C. That's taken into account the probabilities. So that payoff was 586. You'd have to move up the tree, so you multiply it by P. Find its present value, gives you 251. Now, exercising early, well, the exercise price is 5,300. You wouldn't exercise early as it would give you a negative value. Okay, so you don't exercise early. Then finally, at node A, I have to bring back the 1557 and the 251. P moving up the tree, 1 minus P moving down the tree. That gives me 808.379. Would I exercise early? Well, exercising early would lead to a payoff of 150, and 808 is higher than 150, so I don't exercise early. Most people would stop there, but you can't, right? It is in point form, and you're meant to find out the value of this particular option. So you have to take those 808.379 points, multiply them by $25 per point to give you $20,209.48. Okay, that is the value of this particular option. Okay, so it's a 3-step binomial tree. Okay, so it takes a bit to do. Okay, so that's why I'd say it's probably a little bit, well, harder question than a straightforward question you would have done. Okay, but again, everything to do this you've learned in the course, right? You've done all of this before, so as long as you know what you're doing and you check your work, right? Obviously, it will be easy to make a mistake here, right? Take it slowly. Make sure you don't make any careless mistakes. Have you all got emails about your final exam yet? Yes, good. So your final exam's early on, right? Quite early on in this course, which can be good, can be bad, right? But probably that means you should start reviewing your work now, right? Because it is early on, okay, in terms of the exam schedule. Okay, so there are a few past exams up on Wattle, right? This is one of them, right? So you don't need to write all this down. This is a past exam you can find up there. There's a few of them, right? So this would be a good indication of how I would set my final exams and a good indication of the level of difficulty. Okay, of course it will be different this year, right? But the best way to prepare for your final exam would be to go through these. Not yet, right, because you haven't done all the course yet, but any things you have covered so far, look at those past exam questions. That'll give you a good indication of what I think the difficulty will be like in terms of your exam this year. Okay, so that's any questions on binomial trees before we move on to Black-Scholes? Okay, so Black-Scholes, again, you just take the formulas you've covered in the course, and wherever you see an S0, you replace it with S0 times e to the negative qt. Okay, you can do that, and you'll get exactly the correct answers, right? And if you have a look at what you've got at the top up there, for what C and P is equal to, and that's all it is, what you had before. So what you're going to get in the exam, you just add multiplying it by e to the power of negative qt for the S0. What makes it a little bit easier for you, and you can do it with the D1 and D2 if you want, you can take the formula you'll have in your exam for D1 and just replace the S0 by saying S0 times e to the power of negative qt divided by x. You can do that and use the formula as given, but because taking the natural log of S0 times e to negative qt means, remember your log rules, the negative q times t comes down the front, well, what you can do is you can actually just move the negative q into the formula on the right-hand side. So before, remember, it was r plus sigma squared divided by 2 times t. Well, you've got a negative q times t by taking the natural log. So to make it a bit easier, you can just say r minus q right in there. So replacing the r with r minus q. Whatever you want to do, it'll give you exactly the same answer. So if it's easier for you just to say S0 times e to the power of negative qt divided by x, and then it would become plus r plus sigma squared divided by 2, do that. Those of you who think, actually, that's going to be a lot easier on my calculator to say r minus q, then you can just say the natural log of S0 on x, and you move that negative qt into the bracket over that side. So mathematically, it's exactly the same. Algebraically, it's exactly the same. You've just rearranged it to make it a little bit more simpler in terms of what you do on your calculator. And the same will be true for our foreign currencies as well. Okay, so with your foreign currencies, again, you can just say S0 times e to the power of negative rf times t on x, or if you like, you can move the negative rf over there as well. It's still being multiplied by t. Okay, it'll give you exactly the same answer. Okay, so whatever works for you, whatever's easiest. Okay, but you'll see for the C and P up the top, S0 has just been replaced with S0 times e to the power of negative rf times t, the foreign risk-free rate for both C and D. And for calculating D1, just do whatever's easiest for you. Okay, I don't mind. Any questions? Now, another way you could rearrange it, and no one ever likes this, so most of you will ignore it, that's fine, is we know the forward rate, right, is always equal to, well, if we're dealing with a currency, is going to be equal to the spot price multiplied by e to the power of the domestic risk-free minus the foreign risk-free times t. Now, if you rearrange and solve for that, right, in terms of what you have in your equations, you just get the natural log of f0 on x, okay, so the forward rate. Okay, so if I were you, I wouldn't be doing any of that, but if I did give you a question where I said, here's the forward rate, okay, then you'd go ahead and use this equation down here, okay, rather than using previous one. Yeah, in fact, you'd need to use this equation because unless you wanted to back it out, which I guess technically you could, but if I give you the forward rate in a question, you just go ahead and use this particular equation. So again, that's if I don't give you the spot prices. Instead, I give you whatever the forward rate is and the exercise price for an asset. So the example we're going to look at here is portfolio management. So we're going to put together a couple of concepts in the course, and we're going to pretend that you're a fund manager and you're looking at hedging the value of your portfolio. Okay, so this is actually a question that you had in Foundations of Finance. Right, so it's a question from Foundations of Finance, but now we're actually going to value what this insurance costs you. Okay, and then we're going to have a discussion here where you're going to tell me whether you think this is a good idea to take out this insurance. Okay, so what I'm thinking of doing in your final exam, and I'm not sure yet because you'll hate it, but that's okay, is giving you a question and then asking you to tell me what you think you should do. Okay, and the bad thing for you and for me is, as marking it, is there's no right answer. Right, so what I'd be looking for is the justification. Okay, so that's what we're going to do today. We're going to talk about the justification, and you could have 10 different answers, but as long as you justify it, you can get the marks. Okay, so we'll do that in about 10 minutes once we've done this question, and I'll think some more about whether I do this in the final exam or not. Maybe in point form, Okay, so we've got some portfolio insurance, and what information are we given in this question? I should go back to the question. Okay, so a portfolio manager uses index options as insurance against the value of their portfolio falling. So remember you did this in your final weeks of Foundations of Finance, where you were managing price risk. Okay, and the example you used was a portfolio, right, as a manager, and you had to solve for, essentially in Foundations of Finance, the number of options you needed. Okay, so today we're going to do the number of options and the cost of that insurance as well, and then have our discussion. Okay, so what information do we have? So we've got a portfolio which mimics the ASX 200. It has similar returns and a dividend yield. So that means we can assume the beta is just 1. Okay, it's basically the same as the ASX 200. Index option on ASX is 25 times the index, so we have to multiply the points by $25. That's nice to get that in the question. Suppose the manager's portfolio is worth $100 million and the value of the index is currently 5,000. The volatility of the index is 25% per annum, risk-free rate's 9%, and manager wants to hedge the portfolio for the next 3 months. The dividend yield's 5%, and put options can be bought with an exercise price of 5,000. Okay, so it's currently worth 5,000. Options can be bought with a strike price of 5,000. So essentially, you're trying to ensure that the portfolio is worth $100 million in 3 months' time. Okay, the exercise price is equal to the current spot price. Okay, so obviously, what position do you take in these options? What position? Yelling it out. They're put options. You want to hedge your risk. If you're a hedger, what position must you always take in options? Long. Okay, so you can take a long position. Yikes. A long position in these put options. Right, a long position to hedge your risk. How many do you need? What's the cost? So let's have a look. So first of all, how many do we need? Okay, so we will buy or take a long position in put options on the ASX 200 with an exercise price of 5,000. Okay, that's the what do you want to do. Okay, number 2 is the number of options I need. Well, the formula for that is beta multiplied by P on A. Remember, P is the value of your portfolio, in this case $100 million, and A is the value that one contract hedges. So in this case, beta is just 1. It exactly mimics the ASX 200. The value of your portfolio is $100 million, and the value that one option contract hedges is 5,000 points times $25 per point. So you need 800 contracts. Okay, so you're going to be long in 800 put option contracts on the ASX 200. And now we need to work out the cost of our insurance. So we're going to work out how much are the options worth, what's their cost. So cost of insurance. So first of all, we solve for D1. D1's equal to the natural log of S0 on X plus R minus Q, so I put the Q over here, plus sigma squared on 2 times T, divided by sigma root T. So that gives me the natural log, spot price of 5,000, exercise price of 5,000, plus risk-free of 9%. We're going to assume it's continuously compounded because I haven't been told otherwise. Minus my dividend yield of 5%. Volatility was 25%. Square it, divided by 2. And the length of the option was 3 months, 3 on 12. Divided by the volatility of 25% times the square root of 3 on 12 gives me 0.14. Remember, I round to 2 decimal points when solving for D1 and D2. So I'm going to find out what is n of negative 0.14. Because it's a put option, remember it's negative D1 and negative D2. So I'll look up on my tables n of negative D1, and it gives me 0.4443. And D2 is equal to D1, 0.14, minus sigma root T. Gives me 0.02. N of negative 0.02 gives me 0.4920. So P is going to be equal to X, which is 5,000 points, times e to the power of negative my risk-free of 9%, times a quarter, multiplied by n of negative D2, which is 0.4920, minus my spot price of 5,000 points, times e to the power of negative QT. So I remove the dividend yield from the spot price. So e to the power of negative 0.05 times a quarter, multiplied by n of negative D1, which is 0.4443, which gives me 211.36 points. What do I need to do now? Multiply it by what? By 25. So the cost of the insurance is equal to 21.36 times $25 per point, multiplied by what? 800. I need 800 of these contracts. That gives me a cost of $4,227,200. So what happens if the value of the index drops to 4,000 points? I exercise my option. I get the difference between 5,000 and 4,000 points, multiply it by $25 per point, multiply it by 800 contracts, gives me a payoff of $20 million. So the 80 million my index is worth, plus the 20 million means I've got a value of 100 million. What's the problem though? Is my portfolio worth $100 million? No. Why isn't it worth $100 million? Because what does my portfolio also include now? The cost of the insurance, right, which is 4.227. Okay, so my portfolio, if I exercise this in the end, is actually going to be worth, what, $95.7 million. Right, not $100 million. What if the value of the index went up to 6,000 points? Well, then I don't exercise the option. My index is now worth 20% more. So it's now worth $120 million, but I've got to subtract off the cost of the insurance, okay, of 4.227. Okay, so the next question is, would you take out this insurance? Answer in dot point form. So what do we think about? What do we have to think about? Let's imagine your answer is yes. What would you be saying? What would be your justification for taking this out? We're not going to do too well on the final exam, are we? If no one has any suggestions. Who would take out this insurance? Raise your hand. Who would not take out this insurance? Raise your hand. I'm not going to pick on you, I'm just wondering. Who would not take it out? Raise your hand. I wouldn't take it out, right? So no, everyone doesn't know. That's good. Okay. So no one knows whether to take out this insurance. So what should you be thinking about? In percentage terms, how much does this insurance cost? Anyone want to have a guess? How much does it cost? You might sit there and say about 4.2%. That's over 3 months. Right? This insurance is for 3 months, remember? It's a 3-month contract. It's a 3-month contract. So really you should be times it by 4 if you like. Right? So you're really getting 17, 18% per year cost of this insurance. That seems like a lot to me. So if you're doing the no case, that's something I might be saying, right? This is pretty expensive, right? If you annualize it, it's working out 17, 18% the cost of the insurance. Okay, what was the volatility that was given to you in the question? It was 25%. Okay, so 25% was the volatility. Then you start thinking about what has Stephen said in lectures? Well, he said that normally, well-diversified portfolio, it's probably about 17, 18% per year is normally the volatility, so this is a very volatile time. So it's risky. Aha, here's something you could be talking about. It's a risky time because volatility is much higher than what we'd normally expect. Maybe that's an argument for using this particular option. But because it's highly volatile, prices could go up or they could go down. Right? So if you use a forward or futures contract, you're locked in. Right? So you don't get any of the upside gain potentially. But you give yourself a floor in terms of the 95 point whatever, $7 million as a minimum if prices do go down. Right, so you have to argue about what's the alternative. Okay, well the alternative is, there's many of them, use forwards or futures contracts. You could go back to the option trading strategies. I wouldn't, but you could go back to the option trading strategies and say, oh, use a straddle, a strangle, a strip, or a strap, all that sort of stuff. They're obviously going to be more expensive. Right, those combination strategies. That's what you use in volatile times, right? Strip, straps, strangles, and straddles. Those are in volatile times. But they're really expensive because you're buying not just one option, you're buying 2 or 3 options. So I wouldn't go down that path. 25% is not that volatile. Right? If it was 90%, yeah, that's pretty risky. Okay, but it's not. It's just a bit higher than what you normally expect. Then there's an argument for doing nothing. Right? Didn't I say in lectures there was arguments, remember, for and against hedging? And one of them is you shouldn't hedge, right? Because as a company, because you're spending money and people already own these diversified portfolios, why should you pay for it when it's not being priced in the market? That could be an argument you could use. Right? And then some of you will get really into it. And you'll start saying, well, here's the current forecast for GDP growth in the world. Here's the current forecast for what people say is going to happen to the stock market. Right? You might start bringing up trade wars between America and nearly every country in the world. Right? And what that's going to do to stock markets if it were to go ahead, which is not going to be good. Right? So yesterday, Trump's announced he wants to put tariffs on $200 billion worth of Chinese exports to America, right? What's that going to do? Not very good things, right? It's going to make things more expensive for people to buy in America, right? Distort economic trade, all these sorts of things. So that's going to be bad for stock markets, right? So these are sort of things you want to be thinking about. But there's no right answer, right? Someone could say yes, someone could say no. They've got good justifications, get full marks. But if you write yes because the options mean I get at least this amount of money, that's like a half a mark out of 5. Right? You haven't really thought about it by giving that answer. You want to think about all the particular individual arguments you could give to justify why or why not. Right? Maybe a more nuanced answer would be something like, you know, there's a lot of uncertainty in the world at the moment with policies coming out of America and other countries, protectionist policies. There is some downside risk here. Okay, so my argument would be to maybe hedge 30% of this. So not buy the 800 contracts, okay, but buy 240 of them to give myself some protection. Okay, but remember in this question, what it's asking you is, and then there'll be someone really clever sitting there who'll go, right, so Stephen's saying, let's spend $4.2 million to make sure that in 3 months' time I have $100 million. When it's currently worth $100 million, why don't I just sell it now and get the cash? Right? And put it in a bank and earn some interest for 3 months. Right? That could be an answer. And of course I'll come back to you, yeah, but what if the market goes up by 20%? You've lost out. So you'd have to address all those other things. So there's lots of things you could do. Okay, so now that I've said that, and I'm not going to pick on anyone, who would buy these options? Some of these options. Okay, who would not buy any of these options? Okay. Okay, cool. Okay, very good. Okay, so those are things you want to be thinking about, right? And so I've done it for stock markets, but we could do it for something else. We could do it for BHP Billiton. Right, so let's imagine I have a question where you're a fund manager and all you have in your portfolio is BHP Billiton. Right, so it's got dividends, so you can use all the same things we did today to value it. And I say, should you take out this insurance? And then you need to think about, oh, gosh, what's happening in the world with iron ore prices? Okay, what's happening with coal prices? And you get into the same arguments. Well, trade war, lower economic growth, less demand for coal, less demand for iron ore, right? It all links. It's the same argument, right? Same discussion we had before, but you say, well, obviously, if there's an economic downturn, that's bad for coal prices, that's bad for iron ore prices. Right? And then you might bring in some other arguments, right, about demand for coal declining as economies go to less carbon-intensive sources of power, right? All sorts of things you could talk about. Okay, so why am I doing this? Not just because I want to, right? This is probably the most important thing you can get out of courses like this, right? When you go and work for a company, one day, sure, you might be pricing derivatives, you might be talking about the different risk management tools you can use that you've learnt in this course, but at the end you'll be making a recommendation, right? What you should be doing, right? That's what you're being hired for, to provide the recommendation, right? Anyone you can teach, right, how to use these formulas. Anyone you can say, here are the 40, 50 different derivatives you could use in this situation. What your value add, if you like, why you've been hired, right, is to make a recommendation. So look, here's what I think you should do. So that's what I'm trying to get you to think about, right, what you would do. Right, so when you go, a lot of you will get jobs at different places, investment banks, wherever it may be. You'll sit down for the interview and they'll say, what do you think about, I guarantee, they'll ask you, what do you think about the global economy at the moment? What do you think the risks are? What do you think we should be doing? What do you think the outlook for our business is? And if you sit there and you go, oh, look, I don't know. I got straight HDs though. They go, thank you very much. They might be polite, or they might give you some advice. Right, so probably, you know, as you go through your studies, one of the best things you can do is be reading the financial press, right? Knowing what's going on in the world. Okay, that's something you can be doing to make yourself more valuable. Right, and as you get out there and you get a career, you'll continue reading about it. Continue to see what's going on, right? So choose your favorite newspaper, right? Hopefully a reputable one, right? Don't look at news on Facebook, right? Look at good news sources. Right, so, you know, look at The Economist, look at the Financial Times. In Australia, look at something like the Financial Review. Right, good sources so you know what's going on in the world, in your home economy, in Australia. Right, we're all linked. Right, it's all going to have an impact on our future. So that is my hope that you'll do that. Right, to increase your potential to get jobs. Okay, as you go out there. Okay, so, excuse me, next week, we deal with our futures options, right? So these are options on futures contracts. So if you remember back to, I think it was in which week was it? Maybe week 4, we spoke about futures options and I said, don't worry about them too much, right? Worry about them next week, right? So with a futures option, when you exercise the option, you end up with two things. You end up with a position in a futures contract, either long or short, depending on what position you've taken in the futures options contract. Okay, and you end up with some cash. You end up cash that's equal to the exercise price of the option and the futures price when you exercised it. And we're going to revisit everything we've done this week. Okay, so you're going to be experts at it. We're going to deal with the lower bounds for call and put options and put call parity. Same formulas we did today. Okay, but we make some changes because they're futures options. It's probably the trickiest topic because when you exercise it, you have to take into account the fact you end up with a long or short futures contract as well. Okay, so kind of an extra line we have to put in there. We'll deal with changes we need to make to the binomial option pricing model, and it actually becomes really easy. Okay, it becomes P's equal to 1 minus D divided by U minus D. So it's actually one less calculation you have to do. Then we'll deal with Black-Scholes, okay, and in terms of the changes we'll make there. The other thing we'll do next week is we'll look at examples where we have violations of put call parity or violations of lower bounds. Okay, and I'll show you there's always two ways you can solve them. The two ways of solving them are you get the money at the beginning or you get the money at the end. Now, whichever way you did an exam, you'd get marks for both. But my thought always is, with arbitrage, you should get the money at the beginning. Right? So you should always get the money at time 0. You execute it at time 0, you get the money at time 0. Who wants to wait a year for the money? Okay, get the money today. Okay, so that's always my preferred way of solving for them. Remember, you have a quiz. Okay, so your quiz is going to be on the binomial option pricing model. Okay, dealing with either a currency or an index. Okay, so we always do 2 or 3 quizzes. One will be for a currency, one will be for a indice. Okay, not giving anything away there. It's obvious that was what's going to happen. Okay, are there any questions? Okay, if you do have questions, I'll remain down the front, so please come and ask me. Remember, if you want to view your exam script, the only way you can do that is by attending the tutorial you are enrolled in this week. If you don't attend the tutorial, you will not get to see it. Okay, there's 620 scripts. Okay, there's not possible to have you all make appointments in the main office to view them. Okay, so it'll happen in your tutorials. Okay, that's where you'll get to see them this week. Okay, thank you very much.